Well, good morning, everyone. This is Kent Bang. I'm the Director of Swine Lending with Compeer Financial, and I'm glad you joined us today. We had planned originally to have a series of Outlook meetings, and with the COVID-19 issue that came up, decided that clearly that did not make sense to do and gather people in large groups for these meetings. We decided to have a webinar, and we're very fortunate today to have a couple of guest speakers with us. Bill Moore, who is Compeer Financial's Chief Risk Officer, is going to give us a very timely update on kind of what he sees going on in the marketplace here from a global and a U.S. perspective. And then we're fortunate enough to have Brett Stewart join us today, and he will be following up with, Brett Stewart is from Global Agri-Trends. I think many of you on the call, or maybe all of you on the call, know Brett Stewart and maybe know him well, and going to give us an update on the global meat industry and demand. So welcome. I'm glad you're here. We'll get started. I'm gonna lead off here and talk a little bit about, from an industry perspective, kind of where we're at today. So I wanted to start and talk a little bit about Compeer's position. As everyone here knows, this coronavirus outbreak across the U.S. has become a large issue, potentially affecting the health and safety of many people across the United States, especially the aged people. We have made the decision internally that we are going to close all our offices. That decision was made late last week and is effective as of today. But clearly, I wanted to make it clear that it doesn't affect the fact that we are still open. We're still doing business. We expect that we will still be able to supply the same services that we did before. We just have team members that will be working remotely beginning today. A couple of things that people need to be aware of, or probably are aware of, is online banking. So that will become more and more of a method which you can use to view accounts, transactions, history, and move money. Our mobile banking app is available. Check with your folks that your relationship officer. You should be able to, if you don't have our mobile banking app, you should be able to get that and make your life a little easier and make work a little easier. Our client portal will allow you to log on to My Compeer and view account information, statements, send and receive files, etc. And then always, if there are questions related to that, the contact center is clearly will be open through the duration. There's an 800 number, 844-426-6733, and jot that down, and they can help you navigate through those. So we wish everybody safety through this, and this is our, one of the methods that we are using to keep our clients safe, keep our team members safe, and still accomplish what we need to do every day. So topics that I'm going to cover here just real quickly. I wanted to talk about the swine industry supply and the growth of that supply, global pork demand from a key market standpoint, and then profitability and cost of production. So to start with, what I've pulled up here is, it should be on your screen, is the USDA Hogs and Pigs report from last December. And wanted to talk through this. I've got the last 5 years there, so 4 years of changes, going back to 2015, after we got through the our PEDV year of 2014, and by the end of 15, herds had stabilized, and so I think the numbers are meaningful following 2015. But with that said, we increased breeding stock over that 4 years of about 7.6%, or about 1.9% growth on an annualized basis over that period of time. that's pretty rapid growth for our industry, as we all know, and the inventory followed suit. So lots of numbers on there. First off, going to the bottom line, we're up about 12.7%. So what that's saying to me is that in addition to growing our breeding herd by 1.9%, productivity has averaged an increase of 1.3% per year. And so very rapid growth in our industry over that period of time coming out of 2014. A couple of numbers that we will have a new report next week, March 26th. I think the USDA releases the Hogs and Pigs report. I would expect, as you look at a couple of numbers on here, and that would be the 2019 under 50 pound inventory and the 50 to 119 pound inventory. Those were 101.2% of a year ago and 101.7% of a year ago. Not a lot of growth in those numbers. So my expectation is those potentially would be adjusted up, based on the continued growth through last year anyway of the breeding herd. Recently, hog slaughter following that report from December 1st through last week, we're up right at 6% in hogs processed on a weekly basis on average. So it fits pretty nicely with what USDA expectations were back December 1st. The question is what I just went through as far as the under 120 pound inventory and what that means for the next few months. And I think we'll see some adjustments. It just feels like we've got more inventory out there and we'll continue along more of a trend. We'll trend down seasonally for slaughter, but I think we stay above 2019 by something more than 1% over a year ago, which is what the 2019 or December numbers would say. So capacity, the other issue in this, we've got a lot of pigs, obviously. Packer capacity has grown. I've been to a couple of meetings over the last several months and listened to Steve Meyer talk about capacity at 510,000, and I think that's as good as information as anybody has. We're running 495 to 497. I think back in January, one day we killed 499,000 pigs. But 495 to 497 is capacity based on labor. And I think that's the differential. I think we have physical capacity for 510, as Steve Myers pointed out at one point or a couple of points, but labor has kept that capacity lower. The bottom line for me is I think that we can increase capacity if we have labor without adding additional shifts by about 2.5%. The point is we'll clearly be tight on capacity come this fall without some significant change. Just to point out, I think from a meat standpoint overall, our expectations at Compeer is that you can see pork will continue to hit record production, further growth this year. On the top right is beef production, maybe up 0.5%. January was up pretty big, but I think for the year we'll be flat, up a little bit, but not significantly. Poultry is growing. So chicken production is growing pretty rapidly and will continue that growth in record chicken production. And then turkey, not a lot going on there as far as growth, really nothing going on as far as growth. But when you throw it all together, we hit 100 billion pounds of production back in 2017, and we've continued to grow. So we will have plentiful supplies. Brett's going to get into some of where that supply needs to go and will go later on, but we will have plentiful supplies of meat going forward. That's a 13 billion pound increase since 2014. I wanted to switch gears here a little bit and talk about performance. I think as we look at where we need to go and how we need to continue to improve on farm performance, I've got some numbers here I wanted to share with you, and the first one comes from historical numbers from PigChamp. So this is the top line is total born per litter. The bottom line would be, or the middle line would be born live, and the bottom line wean per litter. And you can see the significant growth, over the last 15 years, going from a wean pig average of something slightly less than 9 pigs per litter to 11.2. And the point is, from an individual farm standpoint, are we keeping up with that pace of change? And I think it's critical that we continue to perform from a production standpoint and continue to grow that. This is the same data on the average, but from PigChamp, but looking at average versus top 10 performance in terms of pigs weaned per mated female per year. And the blue line is the average or the mean for that database. And you look at the top line, and that's the top 10%, and the difference is getting wider. And so we know the performance ability is there. This is the first year in 2019 that went over 30 PSY for the top 10, but clearly significant improvement and continued improvement in productivity performance on the farm. Switching gears to wean to finish performance. This is METAFARMS data looking back over the last 3 years. And this is 13 pounds to 280 pound carcass weight, or 280 pound live weight at slaughter. You see culls, death loss, and market sales. Market sales are as a percentage of those pigs weaned. So 91 down about 91%. 2017 was a good year, almost 92%, sold as top market hogs, if you will. Average daily gain, some improvement there over the 3 years. Feed conversion, a little bit of a decrease, but that's getting to be a really hard number to look at simply because of the change in diets, particularly with DDGs in the diet. And then average days on feed, 163 down to about 162, not a significant difference because we're making pigs a little bit heavier. I circled the information in the box, and I think, here's our real opportunity from on the farm standpoint, just to improve mortalities, improve culls, and frankly to market more of those pigs as number ones. And I think as we look at the database from METAFARMS, I think thoughts that I had on that were, number one, we need to market more than 92% of the pigs as number ones. I think we've got farms we know that will do 94 to 95, some up to even 96%, and that's really the challenge and really the cost savings on a farm. And it really is dependent on quality of pigs coming in, health, robustness, everything else that goes into managing those wean to finish or nursery finishing barns. Originally, I thought we should be able to take 8 to 10 days out of here, but with a lot less ractopamine being used in the future, that might be a challenge. And I get it that understanding wean to finish performance gets to be really complex. How do you make those changes? Where do you spend your time? I think just defining the 2 or 3 big items that make improvement is really worthwhile for a producer. And from my standpoint, that, as I pointed out earlier, is pigs marketed to the primary market, feed costs per pound of gain from wean to finish, and then total facility costs. And I think those 3, when you look at those 3 parameters or production parameters, really dictate, the differential in driving cost of production down. And then, of course, wean pig costs coming in clearly is a critical factor. So I wanted to finish up here with just some comparison. We, for years, have looked at the Iowa state model, And I wanted to do a little further explanation along with sharing information that we keep on a large group of producers that are clients of Compeer. So this is the Iowa State University model over the last 15 years. And we've used this model to kind of compare, if you will, or to benchmark against. It's good data. You just got to know, I think, kind of how to use it, and that's what I want to try and explain here today. So this is our internal database that we keep. This represents about 1.4 million sows, kind of all across the United States, if you will. So there's some differences in geography, corn basis, obviously, as well. And it reads from left to right. It reads the nearest term, as you can see. So don't let that confuse you. 2014 is clear to the right. The first 3 quarters of 19 are far to the left. But I want to point out a couple of, there's a lot of numbers on here. I just want to point out a couple of lines. So one, I would say operational cost of production. You can see for the 3rd quarter of 2019, about $68, $69 a hundredweight. All of these are in carcass hundredweight. And right below that, operational profit and loss would be just 45 cents a pig. And then hedge gain or loss and consolidated profit or loss then ends up being $2.55 per hundredweight. So you can see the numbers there. It's not really been a great couple of years, but I'm not pointing out anything that anybody didn't already know. And cost of production on an overall basis, about $65 in 17 and 18, up to about $66 or almost $67 in the first 3 quarters of 19. So when we look at those numbers and go back relative, and I'll get to that in just a second, but you go back to the Iowa State model that we've used, I'll point out the differences in those costs. There's clearly a difference. This is the balance sheets. If you look at September 30th for the last 5 years, you can see some trend. It's still very strong, but on average, but owner equity dropped. Working capital per sow dropped almost like $180 or $190 per sow. And those are 2 that we monitor pretty closely. And I think that most of that, and folks on the phone probably wondering, so why, if folks made money last year on average, why did owner equity drop and working capital per sow drop? And the rationale is the balance sheet grew from expansion. I think that's the biggest explanation. There probably was some distributions from the farm level, but the biggest thing is we did grow the sow herd. We invested in new facilities, truck washes, feed mills, what have you, and that's why the change in those 2 numbers in particular. I think still very strong, but certainly a change over the last 12 months. This is the the chart I was referring to earlier. On the left, comparing revenue for the Iowa State model to our database, and you can see they're very close. Iowa State updated that model here a year ago to represent how they thought folks were selling pigs. So it had a weighting for carcass cutout value in addition to just plain Western Corn Belt. So it pretty accurately reflects, at least relative to our database, revenue for our producers on a per hundredweight basis. And then cost of production, as you can see, that's pretty consistent, but it is $3 or $4, some years as much as $5, it looks like, per hundredweight, where our clients, our database is higher than what Iowa State estimates. And I think it's very consistent. And I think part of that is because of what we spend for infrastructure, overhead, whether that be feed mills, truck washes, filtered barns, wherever we're spending that course, the model that's set up probably doesn't capture that, and I think that's a big part of that difference. But important to note, I think it's still worthwhile to benchmark against that, but you got to recognize, I think, how much better that is, I think, than average producers out there today. We've shared this a number of times with different groups, and I wanted to share it here today. This is, we track our revolver use, and that just says what percentages of our overall revolving credit facilities are outstanding at the end of any given month. And the last couple of years, not a surprise, even when off of December 31st, which skews the numbers a lot, we are higher than we had been. We've been running about 20% of that revolver advance the last couple of years until, or prior to the last couple of years, and then the last couple of years more like 30% or maybe even a little higher than 30% advance. So we're using more of the credit facilities that are out there, and I think just indicative of working capital per sow, the numbers that I showed you before, and just managing this business under very tight margins. So I think a final comment that I was going to make before I turn this over to Bill Moore, our Chief Risk Officer, is that we have a chat feature there. In the interest of time, we'll try to get to questions at the end, but if you are comfortable using the chat feature, that might be the best way to try to capture some questions and try to get those answered as we go through. So next, I'll turn it over to Bill Moore. Bill, if you're ready to go.